You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose and the Loose. I hope you are doing well today. Today, we are going to do a full review of Premium Brands Holdings, PBH.to. Why I am so interested in this one? Well, I got a lot of questions as of late about PBH, and one thing that caught my attention as it was on a full skyrocket mode in 2021 as a lot of other stocks. And after that, nothing, right? The stock used to trade around $130, dropped quickly around 100, and now it's in the high 70s, low 80s, depending on the day that you look at. But yeah, lost a lot of its shining bright stars, right? Today, PBH has a market cap of roughly 3.5 billion. So keep in mind, it's not a small cap, but it's not really a mid or a large cap either. So it is a little bit more subject to volatility. Offers a decent yield, slightly above 4% right now. So is it a time to catch this stock that not too long ago was trading around $100 and now is down 25% ish or something? Well, let's take a deep dive and see how it goes with Premium Brands. So PBH, the business model, quite simple. They have two segments, so specialty foods and premium food distribution. In the specialty foods, most of the revenue is coming from selling a variety of protein and sandwiches. They have small bakery activities, but most of the business is actually protein and sandwich. That's about 60% of the business. They are selling in Canada. They are selling in the US. Roughly, again, 60 to 70% to Canada, another roughly 35-40% to the US. Very small portion to Europe, but it's not a big game changer at this point. Premium food distribution, well, they distribute the food on top of that, and they have a seafood distribution line as well. That is roughly 40% of the business for the distribution food. So what's the narrative? What's the growth potential and the investment thesis around this one? Well, this is a company that operates into a highly fragmented industry. So there are a lot of small players. So they have this ability to grow by acquisition. They have done it very well over the past few years. And what is great is the more you grow by acquisition in this type of market, the more you grow your scale. So you can benefit from economies of scale. You have a wider distribution network. You have more manufacturing plants, and then you can improve your margin. Even better, when you are making an acquisition, you're not only buying products, but you're also buying a book of clients. So there are cross-selling opportunities with the existing products that you have to the new clients and to the new products that you just acquired to your existing clients. On top of that, they are vertically integrated, which means that they will also control each step of the production, up from creating the sandwich and then doing the distribution. So overall, seems like an interesting play in the food business. Should be relatively stable in terms of business wise, definitely not for the stock price. So let's take a let's dig into the numbers. Unfortunately, you cannot see the dividend triangle that I'm looking at right now, but I can give you the numbers though. So the numbers, the 5 years revenue growth, 15%, which was pretty strong. It has slowed down a little bit as of late, but from 2020 to 2023, almost 24, it was kind of just growing double digit every year. So on a pretty solid growth phase. A lot of acquisitions into that. So, and definitely there was a bit of a COVID hype also. You have to take that into consideration. And when you look at the stock price graph before I continue with the rest of the dividend triangle, you can see that it's not the first time the stock goes up really quickly and then goes down. Between in 2017, it was trading around like $40, all the way up to $120 in 2018. Then it dropped down to like $75 in 2019. Went up, went down, went up, went down. It's kind of like a roller coaster ride. But right now, we are into one of those down moments. Why is that? Well, it's being explained, of course, by the trend for the earnings per share. So while the revenue has been quite good, EPS has been shaky at best. Not too long ago, we were flirting with like $4 of profit per share. Now we're down around like to something. So like it's going up and down as well. We're going to talk about the risk in a second, but that is being explained there. And in terms of dividend, which is quite surprising, is the company has increased its dividend by like 10% over the past 3 years. So 10% each year. This year, no dividend increases has been announced yet. The dividend remains the same that was declared in March, paid in April of 85 cents per share. Right now, the payout ratio is above 100%, so that probably explains why. And this is also a good timing to go into the numbers and see what's going on, what's like the bear case. So far, I've painted an interesting investment narrative: growth by acquisition, food business, well diversified, like a lot of like scaling benefits, cross-selling opportunities, vertically integrated. So that's great. The numbers are half good, half bad. Definitely not expecting a big dividend increase this year. So that is something that we will have to take a look at. And now into the risk, the bear case. Well, the thing is, over the past few years, they saw their margin getting hurt by like the two major talk of the town between 21 and 24, inflation and higher interest rates. So inflation first, well, they deal with a lot of like raw materials, right? So a lot of like the chicken, the pork, seafood, and so on. So they have limited control over the cost of all of those proteins. As it increases, it's hard to pass along all the increase of cost to their clients. So that's one thing. So that's going to hurt their margin. Now, higher interest rates, well, for two things. Yes, interest rates are higher, but also the fact that their debt went from 1.5 billion in 2020 to 2.5 billion now, and it likely going to continue to increase because they continue to grow by acquisition. So that's a big, like, it's an interesting growth perspective, but it's also a big risk. There's one thing that I did not like too much when I looked into the investors presentation was the customer concentration. Their top two customers, 27% of their revenue. Top five is 40%. So, and even like during the calls, it was like one customer that would like the demand was a little bit slower, so that affected the company's revenue and of course the margin as well. So that is another risk. A little bit tougher these days to grow but maintain margin and maintain earnings per share growth. So the problem is not to grow the business but to maintain the margin. In terms of tariffs, because they're dealing a lot with the United States, so far should not impact the business since they're vertically integrated and they do have plants in Canada and also in the US. They can just make sure that most of their activities in the US remains there, so they can sell products that are like US based made, so they don't have to care about the tariffs. But still, like a lot of investors are concerned about that. Management said it was not an issue. So overall, you are looking at a business that is definitely not a slam dunk if you're thinking, oh my God, there's a high yield there, I'm going to jump on it. It's a food business. Everybody has to eat. It's super safe. Well, take a breather here. Make sure that you review all the numbers and you understand the risk there, because there's a reason why the stock price has declined. So personally, I love the investment thesis. The numbers a bit shaky. I would probably prefer to see like earnings growth going back in shape before I would pull the trigger. I have no intention of buying this stock at this point, but since I got a lot of questions, I thought, hey, you know what? might be a good timing to review it. If you're looking for companies that have more robust metric, because this one had the problem with the earnings, it would have not qualify as a Rockstar for the Rockstar list. So the Rockstar list is quite simple. We use the Dividend Stocks Rock Screener, and we pull out all the companies that shows positive revenue trends, earnings per share trends, and dividend growth trends over the past 5 years. So you need something to be positive over the past revenue, earnings, and dividend for the past 5 years, and then boom, you're up to the list. And you can download the list for free at moosemarkets.com/rockstars. The link is also in the show description below. You can go there. So you subscribe to the newsletter. And once you're on the newsletter, every month you're going to receive it automatically. We update that list every month using the stock screener. If you're a DSR member, it's even easier because it is already included in the screeners. So you just have to select the Rockstar, and then boom, you can generate the list with a lot more metrics whenever you want. All right, guys, that's enough for today. Tomorrow, we are going to talk about Exchange Income Fund, another interesting company offering a high yield. So we're going to talk about that tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.